Every year, thousands of crypto investors lose money they didn't have to pay simply because they didn't know about this trick. And the worst part? The IRS knows most people are unaware of this loophole. But instead of telling you, they let you overpay. What if I told you there was a 100% legal way to reduce your tax bill, even if you've already made profits? This isn't some shady offshore scheme. It's a perfectly legal strategy that even the IRS acknowledges, but they'd rather you not figure it out. I spent weeks researching crypto tax loopholes, and I found one that can legally save investors thousands of dollars. But first, if you're scratching your head and saying, what crypto taxes? I am so glad you're watching this. Yes, you legally have to pay taxes on your crypto. I'm so sorry. What's worse, in a lot of places, buying crypto with other crypto is still considered a taxable event. So you're not just paying taxes when you sell your Bitcoin for dollars, but when you swap USDT into Ethereum, for example. Every single time you make a trade, you might be triggering capital gains tax, even if you never touched fiat. Even if your money never left the exchange, a lot of people assume they only owe taxes when they cash out, when they convert crypto to dollars and withdraw it to their bank account. But that's not how the IRS sees it. They treat every trade like a taxable event, no different from selling stocks. Now, here's the part that really stings. If you held onto your crypto for less than a year before selling or swapping, you're hit with short-term capital gains tax, which can be as high as 37% in the US, depending on your income bracket. But if you hold for at least a year, you qualify for long-term capital gains rates, which are significantly lower, maxing out at 20%. That difference could mean thousands of dollars saved just by waiting a few extra months before making a move. But most investors don't realize this, and they end up paying way more in taxes than they need to. And the IRS, they're perfectly happy to let this happen. They know that crypto tax laws are confusing, vague, and constantly changing. They count on the fact that most retail investors don't have the time or resources to keep up. And if you make a mistake, it's on you. That's why smart investors, especially high net worth individuals and hedge funds, don't just accept these tax rules at face value. They use strategies to legally minimize what they owe. And in the next few minutes, I'm going to show you one of the biggest crypto tax loopholes that most people don't even know exists. By the way, if you're finding this helpful, make sure you hit subscribe, because I break down finance strategies like this every week, showing you exactly how to keep more of your money. Trust me, you don't want to miss what's coming next. You see, there's a completely legal strategy that allows crypto investors to reduce their tax bill, even if they've already made significant gains. And here's the best part. It's a strategy that wealthy investors and hedge funds have been using for years, not just in crypto, but in stocks, real estate, and other investments. It's called tax loss harvesting. Here's how it works. Let's say you bought Bitcoin at $100,000 during a market surge. Today, it's trading at approximately $84,000. If you sell it now, you've realized a $16,000 loss. While taking a loss might seem undesirable, this loss can be strategically used to offset gains from other investments. For example, if you made $16,000 in profits from trading Ethereum this year, that $16,000 Bitcoin loss can entirely offset your taxable gains, potentially reducing your capital gains tax to zero. It gets even better. If your losses exceed your gains, you can deduct up to $3,000 from your regular income taxes annually and carry forward any remaining losses to future years. But what if you still believe in Bitcoin and don't want to exit your position? This is where the loophole becomes particularly advantageous. Unlike stocks, cryptocurrencies are not currently subject to the IRS wash sale rule. This means you can sell your Bitcoin to realize the loss and then immediately repurchase it, maintaining your investment position while benefiting from the tax deduction. This strategy is 100% legal under current tax laws. However, it's essential to stay informed as tax regulations can change and the IRS may update its stance on cryptocurrency transactions in the future. In the next section, I'll provide a step-by-step guide on how to implement this loophole effectively so you can start optimizing your crypto tax strategy today. Now that you understand the loophole, let's break down exactly how to apply it so you can legally lower your crypto tax bill. Step 1, identify your losing positions. Start by reviewing your crypto portfolio to find assets that are currently worth less than what you paid for them. The key here is to only sell assets at a loss because these are the ones that will offset your taxable gains. Look at your transaction history and note the purchase price of your crypto, also known as the cost basis, the current market value of those assets, the difference which represents your unrealized loss. If you don't track this manually, most crypto exchanges offer tax reports that can help, or you can use a crypto tax software to calculate it automatically. Step 2, sell to lock in the loss. Once you've identified your losing positions, you'll need to sell them before the tax year ends, December 31st in the US. When you sell at a loss, you're creating a realized loss, which means it can now be deducted from your taxable gains. Example, you bought Ethereum at $3,500 and now it's trading at $3,200. Selling it now locks in a $300 loss per ETH. If you own 10 ETH, that's a $3,000 total loss, which can offset $3,000 in gains. Step 3, buy back strategically, avoiding pitfalls. Here's where the loophole comes in. Unlike stocks, the IRS does not currently apply the wash sale rule to crypto. This means you can immediately rebuy the same asset without waiting 30 days. However, to reduce risk, many investors follow one of these approaches. 1, rebuy immediately. If you're confident in your investment, you can sell at a loss and rebuy the same asset right away to maintain your position while still benefiting from the tax break. 2, swap into a similar asset. Instead of rebuying the exact same asset, you could buy something highly correlated. For example, if you sell Bitcoin, you might rebuy Ethereum or a Bitcoin ETF instead, just in case tax laws change. 3, wait for market swings. If you expect a short-term dip, you could wait a few days or weeks before rebuying at a lower price. Step 4, use your losses to reduce your tax bill. Once you've locked in your losses, it's time to apply them to your taxable income. Here's how it works. Offset crypto gains first, losses directly, cancel out taxable profits from other crypto trades, offset stock or other investment gains. If you have more losses than gains, you can deduct up to $3,000 per year from your total taxable income. Carry forward extra losses indefinitely. If you lost more than $3,000, the remaining amount carries over to future years, reducing future tax bills. Step 5, keep records and stay compliant. The IRS has been cracking down on crypto recently, so it's crucial to keep detailed records. Save your transaction history from exchanges, buy and sell receipts showing the cost basis and sale price, any tax reports from crypto tax software or accountants. By following these steps, you can legally reduce your tax bill, reinvest more of your profits, and stay ahead of the game. But this is just one piece of the puzzle. Next, I'll show you how high net worth investors and hedge funds use even bigger strategies to avoid crypto taxes entirely. While retail investors panic sell when prices drop, high net worth individuals, hedge funds, and even corporations use those losses strategically to avoid paying taxes. Take Wall Street, for example. Billionaire investors like Warren Buffett and institutions like BlackRock never pay more taxes than they have to. They use tax loss harvesting to erase millions in capital gains taxes, not just in crypto, but in stocks, real estate, and other assets. Here's how they do it. 1, they take advantage of market dips. When the market crashes, instead of panicking, they sell at a loss on purpose to offset gains from other investments. 2, they immediately reinvest because tax loss harvesting doesn't mean exiting the market. It means playing the tax code so in your favor. 3, They roll over losses for future years. Big investors use massive losses to wipe out tax liabilities for years to come, ensuring they pay the lowest possible tax rate. Besides tax loss harvesting, there are even wilder ways to avoid taxes. Elon Musk famously avoids selling his stock to prevent paying capital gains tax. Instead, he takes out loans against his Tesla shares. This allows him to access billions in cash without ever triggering a taxable event. Crypto investors can do something similar with crypto-backed loans. Instead of selling Bitcoin and paying capital gains tax, they use it as collateral for a loan. The loan is not taxable because loans are not considered income, and they now have cash to spend without ever selling their crypto holdings. This is exactly how the ultra-rich operate. They don't just make money, they learn how to keep more of it. Most retail investors don't use these strategies because they don't know they exist. The IRS isn't going to hand you a playbook on how to reduce your tax bill. Their goal is to collect as much as possible, and they rely on the fact that most people never learn how to work the system to their advantage. And this is just the first step. Tax loopholes are one thing, but how you manage your money after that is what separates the rich from everyone else. So if you want to know how crypto millionaires and hedge funds actually manage their wealth, how they multiply it while paying as little tax as possible, click here to learn how to manage your money like the 1%.